Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, all. Ira Epstein of Linn & Associates with your financial market update. And this is for the late afternoon, just after 4:30 p.m. Central Daylight Time on FOMC day. And this is Wednesday, the 14th of June, 2017, about 4:33 p.m. Central Daylight Time. Okay, Fed Day. So what did the Fed do? The Fed said, they're watching the economy. They still see growth coming, blah, blah, blah. No, they don't. They lowered some growth targets going into 2018 and 19 that I saw. They admit that inflation is missing target, but they still think it's just an event, a transitory event. They raised the interest rates by that quarter point that they said they would. They announced plans to begin the process of tapering back the balance sheet as well. So when you taper back the balance sheet, what you're really doing is taking a big buyer, the Fed, out of the market that keeps buying maturing notes and bonds, then throwing that money back into the market. In essence, if you don't replace it with another buyer, the market says, okay, we want a higher number, a higher interest rate in order to lure a buyer. This could be China, whatever, but that's how the market forces typically work. Okay, you sell at the best price you can, and the buyer comes in, and they're going to try to get the best price they can. But you remove the elephant in the room with $30 or $60 billion a month of buying by the Fed. They did not say when they'll do it. Ms. Yellen did not tell the market if she's going to be the next Fed chair. She doesn't know. So we were left with that. The stock market did pretty well with all that. These are not the settlement prices in the metals. Gold hit the low of the day late in the trading day. Silver got hit too. Remember, those markets settle at 12:30 Central Daylight Time, so you can't go by those. You can see that the bonds and notes had a good day on it, and we have problems in the energy sector because you still keep breaking on the energy prices. Now, when we look at a weekly chart of the Dow, you went to a new high today, 21,388. Big number in the market. When we look at an area chart of just closes, you're up here today to a new all-time high close. So this market is hearing higher interest rates, and yet it's closing at a new all-time high. I think what you have is the market not believing the Fed. I think that when you saw the vote today, and I think it was an 8-to-1 vote with the Fed president out of Minneapolis voted against the rate hike, first time that I've seen that in a while, I think that there's dissension there and people wondering what is going on. We will see, but there's going to be a lot of talk about this. I think if the Fed had not raised the interest rate, the markets would have all been down hard. We'd have all been worried there's something wrong. I think the Fed has to err on the idea of inflation's coming. Maybe they don't have the timing right more than anything else. In the June Dow Jones, the chart action still up. You can see here with a close 21,371. I had 76, but it's 71. It's how they finally figured it. And the swing line's still pointing to the upside. So what do we have? We have the swing lines with higher lows, higher highs. Bullish. The market is over the 18-day average of closes. Bullish. Where might the market go? Upper Bollinger Band, 21,405. Missed it today by 17 points. We're getting into an upper area of concern, but you've still got this very bullish embedded reading, and until that red line gets back under 80, I contend the bulls are content and they feel safe in buying on the breaks of the market. The NASDAQ is the chart where you're seeing the rotation out of the tech stocks, as we've talked about, went probably into the banking sector, as the banking sector now got a quarter point higher rate. I don't think the banking sector likes what it's seeing with the longer-term flattening of the curve yield, where you get the short-term rates being put up by the Fed, but the longer-term rates, they're ratcheting down. It's called a flat yield curve. That's not ideal for growth. We'll see what happens with that. In looking at the market, the resistance pretty clear at 57.83. You got to 57.80 today, so you found that resistance point. You also had an outside day down. So If this market takes out today's highs tomorrow, I'm going to label that a bear trap. The interesting part is it's right into the 18-day average, which throws my theory sort of off, because normally when that happens, I'm looking for a move back to one of the key averages. They're both below the market. Maybe it's the Bollinger Band top that it goes to. I don't know. When we come to the S&P, it was not an outside day down. You made a higher high, you closed lower, and you kept the embedded reading. Still bullish, but just barely hanging on. It's showing its first real signs of weakness. And the Russell acted terrible. The Russell now has lower highs, lower lows, outside day down, overbought. So this market, if it wants to put on a good-sized correction, could look at the 1394.60 level. So it's not the tale of two cities, great book, it's the tale of two different types of markets. The rotation out of NASDAQ into the Dow, which looks to be the strongest of the indices right now. Certainly not strong for the small caps, and the S&P so-so, but on the stronger side. At the same time, we had an outside day to the upside in the VIX. Now, just yesterday, I told you what I expected to occur, and it's occurring. Remember, I told you, watch out here. You're going to bring in those Bollinger Bands dramatically. Look at how fast they're marching in. This isn't because of just this current action. It has to do with how this gets weighted back here and then gets taken over again by the current action with that, and then the formula brings it all in. This was an aberration to the upside. Now the marketplace has got to fight a battle looking for what it does next. I'm going to tell you that I see resistance 1159, support 932, and let it go at that. In the bond market, right up to the upper Bollinger Band on the day of a Fed rate hike, and stalls out. Okay, but you're not in a bear trend, nor are you in a bull trend. You're overbought into an upper target of the market, and I'd call this market neutral with an upside bias. Got it? Neutral in the sense that it's met its targets, certainly an upside bias because it's over the 18-day average. Overbought as well in the 10-year note. That doesn't mean you can't push these rates up even more. I think it'll be difficult is what I'm saying. As for the bear case where you're calling for higher interest rates down the road, that's out the window. You think you're getting a September rate hike? That's out the window. You'd have to get a dramatically different look from all the economic data we're getting to get that back into play. I'm not knowing what's going to happen in December, but you've got 3 months of employment data, inflation data, and so on to get September back on track. And it's gone from a market that was double-digit certainty to now an 18 or 20% probability of a rate hike. Dollar index did pretty much what I would expect. Went down today to the lower Bollinger Band, found its footing, bounced away. The importance of that Bollinger Band, and you know it, that's your objective that a lot of traders look at. Support when it's first hit, resistance when it's first hit. Doesn't mean it can't go to it and lower, but you're only going to settle outside of that band 5% of the time the way the algorithm is built. In the euro, you went right up to the upper Bollinger Band. You got to 112.99. The number is 112.85. You pulled back. It's still a bullish bias from the swing line, but you closed under the 18-day average. They negate each other, and momentum is flat in the market right now. British pound. Well, you have short covering. You first found your support at the 100-day average of closes earlier in the week. You've bounced away, and you turned the swing line up, but you're still under the 18-day average. This is about as neutral a market as there is, and the market that is still powerful is the yen with higher lows, higher highs again. It did go to its upper Bollinger Band and stop there. Those Bollinger Bands are just so important when you trade. In the crude oil market, need I tell you, the API numbers and the EIA, both terrible. So the market's back down, and these are lows that we were at once before. So you're at that zone. Remember I kept telling you that we've got a trading bottom, trading top. I'm still going to call it 44 to 53 roughly, and we're testing the lower boundary of it. Let's see what it does as it gets there. Gasoline, though, is a whole different world. We are going into Father's Day. This is driving season, and look at how prices are collapsing in gasoline. And the futures down 6 cents today, so you're not going to be driving around the country seeing raising of energy price, be it diesel or gasoline. You're probably looking at lower prices wherever you go, and guess what? Nat gas, that hot spell, it's followed by cool weather. I mentioned that yesterday. You tank the market. These are the most recent lows that you've got on this chart. So for those of us that spend money on nat gas, yay! Let's see what happens with all that. I want to tell you that let me get to this, my market research. I'm writing my gold report. Now, I decided to write the gold report, and I haven't written one this year at all. This is going to be a longer term report. It's looking at just monthly charts using my swing lines, key moving averages, MACD for those of you that follow that. I'm bringing in the Fed, what they just did, and giving you a longer term picture on the chart. I've given you the breakout numbers on the chart. Would you like to get a copy of it? Because it's all part of my market research. If you get my research, you're going to get it because I'm going to send it out tomorrow. How do you get it? Call us at 866-973-2077. That's the best way to make sure you're going to get this. Without doing that, you can always come up here and click on this YouTube icon. And from there, there'll be a form to fill out. Go for Ira's Market Research. Underneath us on many websites, it says click here for Ira's free offers. Do that, and the form will be there. Do it that way. And you can go to our website at www.iraepstein.com. There'll be a carousel of free offers that you'll see. Click on really any of them. The forms will come up and choose that. But not only will you get the gold report, you'll get 20 days of my regular research along with access to my all-important morning video. And this normally runs $60 for 20 business days roughly. It's yours free if you haven't tried it before. If you have, you're out of luck. Subscribe. So 866-973-2077. Talk to you tomorrow.